Hey folks, welcome to today's Steady Trader YouTube Live. What I wanted to talk about today for just a couple of minutes is to go through and talk about this relationship between bond prices, and we're going to mostly talk about US Treasury bond prices versus stock prices. And we actually just yesterday saw bond yields rally to 10-year bond yields rally to highs you haven't seen in a long time. In other words, bond prices went down. So this is an inverse relationship between yield and price with bonds. But there seems to be this almost epidemic out there where people think that if stocks rally, bond prices have to go down, and if bond prices go down, stocks have to rally. And what I wanted to show you, I have one simple chart, but very effective chart to basically prove to you that that relationship does not really exist. Now, it's all about your time frame. So let me just show you the chart, and then we'll kind of come back and forth, and I'll go through this, because it's really dangerous to assume that if stock prices go up, bonds go lower, and vice versa. It really depends on the environment. So let's have a look at this chart. And what this chart is, in green is the S&P 500, and in red is the price, not the yield, the price of the 10-year US Treasury. Actually, it's longer term bond yield. It's like 20 plus years, but it's more or less kind of goes with what the 10 years is doing. And you can see that even though there's times when we have diversion, right? So in this case, for example, you can see bond prices going lower while stocks keep going up. We have times when this divergence happens, but broadly speaking, since 2009, we've seen both bond prices ascend over time, and of course, obviously, stocks have gone higher as well. What's interesting at this juncture is that we're seeing another one of these big diversions taking place where we have stock prices, so again in green, the S&P 500 continuing to ascend, but bonds are really taking a tumble here. And let me just take a minute and kind of go through this relationship. So for example, so bonds are more complex the way that people look at them than stocks, because bonds, and we're talking about government bonds right now, they can be looked at both as a source of sort of income, as well as a source of safety. But for example, if things aren't looking good in a particular country, so like outside the U.S., which is the base currency still for a lot of purposes, let's say a European country or a country in South America is starting to have problems economically, then those stocks aren't going to do well. But guess what? The bond prices aren't going to do well either, because there's more and more credit risk. With the U.S. market, that's a little bit different. So what I'm looking for right here specifically to give you a basic, not an immediate gratification trade idea, but something that's I'm looking at to try to bank on over the course of the next few months, maybe a couple of quarters or so, is basically another mean reversion move where I would think that stock prices will come down and bond prices will go higher to some extent, right? So this is a more intermediate term kind of trade. As you saw before, longer term, there's really not a whole lot of relationship, at least going back to 2009 at this point. And even beyond that, if you were to look at it, there's not a whole lot of correlation. It depends on your time frame, but I think right now, if you want sort of an actionable idea through the next few months, really more the next few quarters, I think some sort of a mean reversion here makes a lot of sense. And that's it for today, folks. I hope this is helpful. I'll see you guys in the next video. Take care.